Hi, Matt McAleer, Director of Equity Strategies. January 15th, just after the close. Well, after the rip we had in the fourth quarter across the board in terms of indexes, sectors, industries, small, mid, large, just natural to get a little pullback, a little reset of some of this pricing. Broad markets down anywhere from 1% to 2% this week. Keep in mind that small and mid did keep a bid throughout the week. That appears to be more than just a reversion to the mean trade. Remember, mid caps have trailed the S&P the last 5 years by close to 40%. Dividends included gets a little bit higher. This reversion to the mean trade has cut into that. Small caps as well. Small caps have outperformed the NDX and the S&P by 3 times over the last 3 months. What did we notice as far as sectors? What did we do in our strategies this week? In U.S., we're full in terms of our allocation. We liked what we saw out of bank earnings. Keep in mind, we spoke last month, about the Federal Reserve loosening restrictions on banks, letting them buy back stock, letting them raise dividends as long as they hit certain profit thresholds. That income is important. We had JP Morgan and a handful of other banks, Wells Fargo, come out last night. Solid numbers. JP Morgan looked bulletproof. Stock sold off after its 40% move over the last 4 months, which is natural, selling the news. In terms of where we'd like to add more, perhaps, remember JP Morgan, part of tactical trend, KBWB, which is a basket of large cap banks, part of our U.S. equity portfolio. We'd like to be buyers on pullbacks here. We like the dividends. We're being paid over 3% in our JP Morgan position. Comfortable there. Let's switch over to another area that hasn't performed over the last 3 years. Remember, banks have been left out. Energy. We've spoken throughout the quarter, throughout the 6 months, about the great trade David Kotok put on last spring, really winter into spring, in the alternative energies. TAN, FAN, FO, you've heard me say it. Solar, wind, and water. Tremendous trades. TAN up over, well, let's call it on average price, over 100%. Many accounts, as you know, are higher than that. This week, we saw a little pressure come on the alternatives. A little pressure come into those names. While energy was the best performing, traditional energy was the best performing sector this week. Had some weakness today, but up solidly through the week. I'm wondering if the Fed keeping rates low, keeping rates virtually at zero, and tough for people to find cash flow in terms of yield, if those Chevron dividends and Exxon dividends are starting to become attractive to people. We are talking about 4, 5, 6% yields. Sure, there is certainly price vulnerability, but yield can be a big dictator of money flows. We'll see if those traditional names in the energy patch can keep moving. We do not have any allocation to them. So if they do keep moving, we'll be left behind a little bit there. Got to keep our eyes open. Got to stay flexible. Everybody enjoy the weekend. Keep in mind, markets are closed on Monday for Martin Luther King Day. We will be back at it Tuesday morning, and we'll see you next Friday.
Good afternoon. I'm John Mousseau. I am the President, CEO, and Director of Fixed Income here at Cumberland Advisors. It's Friday afternoon on January 15th. Quiet week in the bond market. 10-year bond is closing the week at a 110. 30-year bond is closing the week at about a 185. Down, say, 1 tick on the 10-year, 3 ticks on the 30-year. Some of that from the bad news that we saw on initial jobless claims this week. Much higher than expected at a 965 when the market was expecting about 800. Points to the kind of the softness in the economy, particularly as we've had the re-flare-ups of the virus, even as the vaccine applications step up. What we did have this week was an announcement by President-elect Biden of an almost $2 trillion stimulus package. That is going to include $350 billion for state and local governments. That's good for Munis, which had a quiet week with hardly any movement in them. What we do think is that you will probably see a somewhat reduced package, just because you still have to get certain Republicans on board, etc. So we expect the package to be smaller by the time it gets through, but we do expect a pretty decent package to get through. And that is good for the economy, and that is good for certainly municipalities if they get that part that's been lacking in the last package. One thing that we still think, though, is that inflationary expectations should rise over time. This was certainly a week of backing and filling a little bit, but we think as you go forward, certainly economic activity should pick up. As the vaccine rates pick up, the perception of higher economic activity should also start to kick in. This week we saw inflation be pretty well behaved, but when you look at CPI and PPI, which basically are at 1.6 and 1.4 respectively year over year, we know that as we go forward, some of those monthly statistics from last spring, which were dreadful, will come off of the calculations and some higher numbers will go in. So as we make our way towards the summer, just the pure math of getting rid of the downshift that we saw last spring should push those numbers somewhat higher. One thing we'd like to tell you about is that we have a new look at Cumberland, a new logo. You will see it, unveiled it this week. We don't change things too much around here. David Kotok, who is the founding partner of the firm and is still the chairman and chief investment officer of the firm, started the firm in 1973. And we haven't had too many logo changes in that time period, but this is one of them, so we hope you enjoy it. We'll see you next week. Next week we'll again look for initial jobless claims, and of course, as we go through the inauguration, we'll see the markets turn towards a new administration. Have a nice weekend.